Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review, Trump tariff talk. So the market was certainly overdue for a correction heading into 2025 with valuations elevated and the potential for a bit of a cyclical slowdown after a government spending binge over the last few years. Now, tariffs seem to be a convenient excuse for some of the recent market volatility, but actually over the past couple of weeks, markets have in fact stabilized and even modestly moved higher off their lows. And that's coincided with additional tariff announcements coming out of the White House, including a new 25% tariff announced earlier this week on imported cars and car parts not manufactured in the United States. Additionally, tariffs on pharmaceuticals, aluminum, and lumber are expected in the near future, with semiconductors to follow later, although the exact dates on those things remain unspecified. Now, the reciprocal tariffs are expected on April 2nd. That's essentially designed to match existing duties charged by foreign countries on U.S. goods. Now, there's a fair amount of debate as far as what the ultimate effect of these tariffs will be on the economy, but suffice it to say there will be some winners and some losers in the battle to bring more of the manufacturing capacity back to the U.S. So far, however, anyway, the stock market really seems to be taking a lot of the news in stride. For this week's featured insight, compounding returns. Albert Einstein is famous for calling compound interest the eighth wonder of the world, saying that he who understands it earns it, and he who doesn't pays it. Compound interest or compound returns basically refer to the idea that if you reinvest your earnings, whether that be interest or dividends, you'll earn a return not just on your original investment, but on the accumulated gains as well, earning interest on interest, if you will. Now, the more time you have to allow this process to take place, the more impressive the effects of the compounding. For example, if you have a $10,000 investment that pays 5% interest, you'll earn $500 per year, or $5,000 over the course of 10 years. But if you reinvest the interest at the same 5%, you'd earn a total of $6,289 over that same 10 years. Not impressed? Well, over 30 years, you'd more than quadruple your money with compounding at 5% versus making 2.5 times without reinvesting. Patience and consistency are key to this, but compounding is a concept that all successful investors know. Looking ahead, all eyes on the job market. In addition to tariffs, there is some concern that cuts to government payrolls will start to weigh on the overall job market and consumer spending. Next Friday is the all-important and widely followed non-farm payrolls report, otherwise known as the monthly jobs report, which will report various metrics on the labor market developments during March. Now, the job market also happens to be one of the most important factors in the Fed's calculus regarding decision-making on monetary policy and interest rates. Right now, the markets seem a little bit more concerned about the growth outlook than the outlook for interest rates. In other words, a really weak report would cause more concern about the economic outlook, even if that means the possibility of more interest rate cuts from the Fed. What the market really likely wants is a report that's strong enough to signal the economy's on solid footing, while not too strong so as to introduce the fear of potentially higher rates. Otherwise known as Goldilocks. Not too hot, not too cold, but just right. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.